With this, let me come over to the summary of the existing knowledge and start with the first question. And the first question is, what is cyber risk? So maybe the first point that I want to mention here, of course, we need to provide a definition. So cyber risk, it's a pool for various risks, and what we do in the paper is we define cyber risk in relation to another risk category, which is also well known in the banking and insurance field, and that's the category of operational risk. And if you use that, one potential definition that you can come up with is any risk emerging from the use of ICT, information and communication technology, that compromises the confidentiality, availability, or integrity of data or services. And important in this definition is that here you have the three classical goals of information security: the confidentiality, the availability, and the integrity. Integrity, in a sense, is what I see real, or is it somehow manipulated? And what you can then do is you can set up this nice causal chain described here. So it starts with a cause of cyber risk, and that's quite interesting because the motivations for cyber losses can be quite different. So it can be criminal, non-criminal, it can be intentionally, it can be non-intentionally. So the motivations for cyber losses can be very different, and I just mentioned one example here. You might already know that, the so-called grey hats. So these are people that use criminal methods for hacking. However, they do not do this to enrich themselves, but for ethical reasons. So you find the third edition of the Grey Hat Hacking Handbook, the Ethical Hacker Handbook. So, and I think this is a very nice example showing that the motivations really can be very different. So we start with the cause that then has an impact on our information and communication technology. And the important point is then the spillover, the potential spillover on our operational technology. So here we talk about the business interruption, the infrastructure breakdown, or also the physical damage to humans or properties, as for example illustrated here in this example, where you can see a fire in a plant due to a Trojan. Yeah? So as an example also for physical damages. What we then also do in the paper is we look at the cyber risk characteristics, and I really believe that cyber risks are unique in a sense. So what we do in the paper is we compare standard property risk, liability risk against cyber risks, and we also compare more non-conventional risks like terror risk, catastrophic risk, nuclear risk against cyber risk. And if you do those comparisons, then you come up with a number of special characteristics. The first two to mention maybe is the data uncertainty and the modeling uncertainty. So still today, we do not really have good data on cyber risk, which is a necessary precondition also to do the modeling, and there are no established methods for how to model cyber risks. Another problem that arises is the so-called risk of change. So if you have some data, you have the problem that this might not necessarily be a good indicator for the future. And even if you believe that you have good data, which also is representative for the future, you have two additional problems. You have the risk of extreme events. Yeah? So many people expect that there are some extreme scenarios possible in the cyber risk field. And you have the problem of the interdependencies, meaning that the classical IID assumption might not be fulfilled because cyber risks do not tend to be independent, as also illustrated here in the picture provided here. So these are some of the cyber risk characteristics, which in my view make cyber risk very special also from a modeling point of view. And so let's move on to the second question, the high cost and manifold detrimental effects of cyber risk. And many of you will be aware of these multi-billion-dollar estimates of the global costs of cyber risk. So these are really enormous numbers. You see 130 billion, 445, up to 1,000 billion US dollars. So the estimates, they vary substantially, also depending on the scope of a study. So is it direct or also the indirect cost that you estimate? The estimates, they also vary substantially by country. And important, those estimates might be biased. You can see most of them are published by software firms, security firms, and those might have an incentive to present relatively high numbers because it's good for their business. And there is this nice paper by Anderson and his co-authors outlining the methodological flaws of these estimates and also providing a methodological alternative, which in aggregate, however, also comes to a number which is larger than 100 billion US dollars. So anyway, it seems to be economically a very relevant topic. And the effects are not limited to these cost estimates, but there are really manifold detrimental effects of cyber risks on companies, on individuals, and also on the general economy. And if I maybe take one example here, if you look at the effect of cyber risks on companies, there are very nice studies that look at the development of stock prices after cyber events. So you can use the event study methodology to look at the stock price development before and after a data breach, for example. And it's quite interesting to look at those studies because what you see is that, of course, the results, they vary depending on which industry you have. But on average, the market value of a firm goes down by 2% after a data breach. However, at the same time, you can observe that the market value of security firms goes up by 1%. So there seem to be positive and negative effects that weight out each other here. And also, if you just look at the numbers 2% and 1% of the market value, doesn't seem so extreme if you compare it to these multi-billion-dollar estimates that we have seen here on the left-hand side. Then, of course, the effects on the individuals, and I think we are all very aware of the loss of control that we are observing with respect to our personal information and also the increasing awareness in that context. And last but not least, mentioned here, the effects on economic growth. And there's this nice recent study published by Zurich in collaboration with the colleagues from the University of Denver that look at the costs and benefits of ICT and find that at the end the benefits of information and communication technology still outweigh the costs, which is good news. But the important point here to take away, definitely the major part of the effects at the end of the day are maybe more the indirect effects. So when it comes to talking about reputation or when it comes to talking about the loss of trust. By the way, maybe I shall mention here, if you are interested in any of the studies that I'm citing here, I'm more than happy to provide any information. Just write me an email after the webinar. I can make everything available to you. So let's continue with the third question. And now we come to these core questions for insurance companies as they develop their cyber insurance portfolios. So we look into the first fundamental problem of cyber risk, and I believe that on this I have relatively good news to tell. It's clear that data on cyber risk today is still relatively scarce, especially because victims are reluctant to report such events. However, since 2002, US entities that experience security breaches are required to report the information to their customers and to other parties, and this has enhanced data availability over the last years. So if you look at the information that you find today, is you find a lot of aggregated information, a number of studies which are also cited relatively often. However, we also find increasingly raw data available, and this is of course much more interesting for insurance companies when developing cyber insurance policies. So let's maybe have a look at one or two of those examples here. So one thing that we did here in St. Gallen is to look at operational risk data. So we looked at the world's largest database on operational risk with 30,000 operational loss events, and with a predefined search algorithm identified 1,500 cyber cases. And 1,500, of course, is already an amount of information where you can do some statistical analysis on. If you look at the other examples that are mentioned here, that's more related to data breaches, more related to the US. So of course there are still a number of limitations, so mainly data breaches, mainly US data, and it's not so clear in how far This can be generalized to other events or also to other countries. And of course, we also have the risk of change. So it's not so clear whether all this information that you find here is a good indicator for the future. But at least we have a starting point that we can use also for modeling purposes, and that brings me to the fourth question. So how can we model cyber risk? I guess most of you will be aware that due to the poor data quality and the fast changing risk landscape, most people tend to rely on scenario analysis when modeling cyber risks. However, we here also in this study, we try to go a little into an alternative direction and really try to look what we can do with the existing data. And if you do that, so here you see an outcome of one recent paper that we did with this operational risk data set. And so what you will find is that you have to use extreme value theory to model such type of loss events because cyber losses tend to be heavy-tailed. And typically we then use the peaks over thresholds approach. And for example, then you use the log normal distribution and the Pareto distribution to model the severity. And this is exactly that is also represented here in this illustration. And the problem that then arises is the following, and this is very nicely illustrated in a paper by Ibragimov and his co-authors from the Review of Financial Studies in 2009. It's a so-called non-diversification trap for the heavy-tailed risks. And this is something that I would like to illustrate with another little picture from a recent paper written by us. So what you see here is, so on the vertical, you see the amount of risk as defined by the value at risk. So here you have the amount of risk. And here, 5, 10, 15, 20 are the number of risks that you have in a portfolio. And the line at the bottom here, that represents normally distributed losses. So here we assume the normal distribution, and those of you that have studied business and economics will know that this is the classical Markowitz case, so the classical portfolio diversification case, illustrating that the more risks you have in a portfolio, on average, the lower the risk will be. So that's the classical portfolio diversification, and that applies for the normal case, and it also applies for the log normal case, which would be more relevant for the standard type of insurance losses. However, on the other side, you see here on the top, that's the Pareto case. So that is the development of the risk in this portfolio if you assume that those risks follow a Pareto distribution. And here you observe what Ibragimov calls the non-diversification trap, meaning as you accumulate risks in a portfolio, the risk is not reduced, but it goes up. And this is a very relevant result. When you now start developing those portfolios, you of course hope to see diversification. And at the end of the day, it's not so clear whether this is going to happen. So the relevant question is now, where are cyber risks? Are cyber risks more here at the bottom with the log normal, or are they more here on the top when it comes to the Pareto distribution? And the thing that I can show you here today is the line in the middle. And this is the result of a little bootstrapping exercise that we did with our cyber risk data. So it's just an illustration really with bootstrapping, but it shows you that the cyber losses are somewhere in between, right? Somewhere between the log normal and the Pareto case, and it's not so clear whether diversification really works as you hope it to work when it comes to accumulating cyber risks. So that's the first problem, looking at the extreme events and the heavy-tailed nature of cyber risk. And unfortunately, that's only the first problem. There's still a second problem to come. And this I describe here. Another problem is, of course, the dependence structure. So we have those non-linear dependencies when it comes to the aggregation of cyber risks. So all these pictures that you see here on the top, all these are generated assuming independence. So here I assume independence among the different risks. However, in reality, cyber risks are not independent. And there's one nice illustration for this from a paper by Böhme and Kataringer. And they differentiate among internal correlation and global correlation. Internal correlation meaning that there's one effect, one event that affects several systems within one company. And global correlation, high global correlation would be one event which affects many firms. And it's now quite interesting to see that depending on which type of attack you look at, it makes quite some difference. So for example, an insider attack, we would say that this is an event where only one company is affected. So the company in the neighborhood is not affected whether I have an insider attack or not, but it will have a high correlation within my firm, right? And on the other hand, if you have a virus, of course, that would be relevant not only for my company, but also to my neighbors. And now if you look at this table from an insurance point of view, clearly it makes a big difference now which type of attacks you want to insure. You will be especially interested in the low correlation events, right? So events like the insider attack or the hardware failure, these are things which are insurable and which you would like to insure. And maybe on the right-hand side, the viruses or the phishing events are those which are not so much of interest for us as insurance companies, because there we would expect high correlation in case of an event. So overall, these extreme events and also these dependencies, they really pose significant uncertainties when it comes to the modeling, and they also pose significant challenges when it comes to the insurability of cyber risk. So let me continue with the question number 5. How should cyber risk management be organized? And I believe this is the question which is maybe best explored among the 10 questions. So here we really can see that there are a lot of standards and tools that you can use for cyber risk management, some of which are also mentioned below here. So you find ISO standards, you find cyber risk assessment tools, for example, by March. So there are special standards and tools for cyber risk management in each step of the classical risk management process. And what we then try to provide in the paper, we try to provide the main guidelines, the fundamental guidelines for cyber risk management, which are listed here. So the first point is maybe the most important one, the institutional commitment. So it's really about having somebody with the hat in the company that is really responsible for these things. And there is one study looking at US data showing that if there is a chief information security officer implemented in a firm, then the average costs of a data breach are 30% lower. And I believe this has something to do with the fact that there are really clear responsibilities within those firms. Then, of course, crisis management is very important. So you have clear plans in case of events. Then the communication is very fundamental with employees, with customers, and with suppliers. And of course, the monitoring is very fundamental, given the fast-changing risk landscape. And last but not least, if we look today, the focus in cyber risk management definitely is on risk mitigation. And the question is, what is the role of the risk transfer? So what is the role of insurance when it comes to cyber risk management? And this leads us to the question of cyber insurability that we will look at in question number 7. Before we come to that, let's have a quick look at the question number 6. Is cyber risk a threat to the global economy and society? And this is a question which is also discussed in the media regularly. And many of you will be aware that a global failure of the internet is rather unlikely than likely. And there are also good arguments for that. And one of the arguments I just provide here in this picture. This picture here shows you the system of the submarine cables. And today the data volume of the internet is still largely organized across these submarine cables. And if you look at the system, you can see that if one cable breaks down, then it's easy to retransfer this data volume across other channels. And that's the main argument why many people say that a global failure of the internet is rather unlikely than likely. But definitely regional breakdowns already occurred. And the same also holds for other scenarios that are discussed in the literature, like the blackout of energy systems. By the way, the example that I gave you, the regional internet failure of Switzerland, it's something that happened just this year, not more than 24 hours, but for almost all one day, where the biggest internet provider in Switzerland had an internet breakdown for almost 1 day. So it's really a scenario which is likely the regional limited breakdown. Now, given the globalization and given the global connection, of course, the consequences of such a global scenario, they would be enormous. And there's this interesting study by the World Economic Forum that analyzes exactly this global scenario, and they come up with a probability of 10% for a global failure of the internet in the next 10 years. And they also estimate the economic consequences, which are $250 billion already after a few days. So this really illustrates the consequences would be enormous, but the likelihood is maybe not so high as the regional limited breakdowns. Of course, for insurers, these scenarios really pose the difficult accumulation risk. So this is definitely a scenario which would not be insurable. And this brings us then to our cyber insurance topic. So where do we stand on cyber insurance? What is the status quo? And what about the insurability? And so definitely we can say that today the market is very small. Of course, the US is far ahead the rest of the world, also because they have these reporting requirements in place since a couple of years. So if I compare the US with the rest of the world, in the US I would say it's already an established insurance market with a premium volume which is in an area of $3 billion. In the rest of the world it's really very small numbers, and I provide you some numbers on the next slide. Also the focus on the coverage is very different. So in the US it's mainly liability coverage. If I look here in the European contracts, the focus is more on the property coverage. The main insurability problems are listed here, and the first of those we already discussed: the lack of data, the lack of modeling approaches, risk of change, and the accumulation risk. Maybe one additional important element that we also have to see is the problem of asymmetric information between the insurer and the policyholder. So we have adverse selection problems. If you want to sell cyber insurance, you do not get the average customer, but you would expect to get only the bad customers. And we also would expect moral hazard problems. That means with insurance, maybe the behavior changes. So both adverse selection and moral hazard poses insurability problems here. Then if we look one step ahead, another problem is that the conventional policies, both in the property and the liability domain, are frequently silent on whether cyber losses are covered or not. And one prominent example in the European context here would be D&O insurance. So I believe that in many D&O policies in the European marketplace, it's not so clear whether cyber events are covered or not, and it's definitely clear nowadays that cyber risks are the responsibility of the top management. So I could imagine that this is also an area of problem, these silent coverages. And if we look at the cyber policies today, I think it makes sense to differentiate a little across the cyber risk of daily life and these extreme scenarios. So the cyber risk of daily life, the hacking attacks that we can see in the media also every day, I believe those are not too big to insure. So I believe this is something which is insurable already today. However, collaboration within the industry might be very useful to improve the insurability of those risks. And a prominent example here would be pooling of data. So I think pooling of data on cyber risk definitely makes sense, and it's also something that the industry is increasingly developing. I recall 2 weeks ago we were at the Chief Risk Officer Assembly, and this was exactly one of the projects that they are now being implemented. On the other hand, we have those extreme scenarios, like this global failure, also the regional limited failure of the internet. And I believe these are really things which are very, very difficult to insure. And here it might be needed to talk with the governments, right? So I believe that here the governments need to be integrated, and maybe solutions like the public-private partnerships are needed here, comparable maybe to solutions that we also know from cat risks in the United States. Okay, so here you see some of those volume numbers. As I said, in the US, it's already a big market. If you look at the comparable numbers for the rest of the world, you can see it's really small. But you also see the growth rates, right? So we expect to see high growth rates in the future years. And the question is, in light of the insurability problems, is this good news? So is it good to grow on cyber? And for this, I just have two quotes here, two quotes from rating agencies. So I have a quote from a recent report by Fitch talking about cyber insurance, and what you can read here is that aggressive growth in standalone cyber coverage or movement to high portfolio concentration in cyber is considered as ratings negative. So underwriting, pricing, and reserving uncertainty currently outweighs the potential earning growth benefits in this field. So the rating agencies, they are really critical on doing too much in this area, and then they also write that only controlled growth as part of a diversified portfolio coupled with continually enhanced underwriting standards would generally be neutral to rating. So I believe this is evidence for rating agencies also being a little critical about high growth in this area of cyber insurance, and maybe also in light of the problems that we have discussed before. Now I would like to come to the second poll that I have prepared, and to motivate the second poll I want you to look at this survey here. You might have recognized that so far I talked only about the supply side. I only talked about the supply side of cyber insurance, and I didn't say anything about the customer. And this might be a little surprise for you, because if you read industry reports on the cyber insurance topic, then typically you get very different feedback. So what you see here in this picture is, what are the biggest obstacles to selling cyber insurance coverage? And if you then read the important answers, not understanding the coverage, and not understanding exposure, not understanding coverage, the cost, the application process, the different policy forms. So these are all problems which are more on the demand side. However, I only talk about the supply. So the question that I would be interested to asking here is, in your view, is the demand or the supply side the main limitation in the development of the cyber insurance market? So we have three potential answers. The demand side, the supply side, or both the demand and supply side. And I'm very interested in seeing your answer on this question. Actually, I asked the same question also 2 weeks ago when I was doing a presentation at the Chief Risk Officer Assembly, and it will be interesting to compare the results of this group here with the results from the CRO Assembly. And maybe I ask Anthony to go over to the results. So let's have a look at the results. Okay, so we see only 7% see it only for the demand side, 15% for the supply, and the majority of the group believes that both the demand and the supply side are the reasons here. By the way, I just recognized that 56, 15, and 7 will not add up to 100. So we have to look how that fits together. But anyway, it seems to be problematic on both sides, both the demand and supply side. So thanks for your feedback on this.